Hello everyone and welcome to this project on investment risk management. My name is Bekros Bekochilov and I work in investment banking and equity research as an analyst. I'm also the associate member of the Chartered Institute for Securities and Investment. Most of the skills that helped me break into this field I got from Coursera. That's why I'm sure that my experience in capital markets will be beneficial to you, so that you'll grasp some skills that helped me start my career and still help every day. You can follow me for my future course offerings at coursera.org/instructor/Ochilov, and I already have some courses up here. For this particular course in investment risk management, there is one prerequisite which I strongly recommend you to take so that you will know what are we talking about in this course. This is compare stock returns with Google Sheets, which talks about some very important things like Sharpe ratio and Sortino ratio. And we'll be actually comparing the metrics that we will use in investment risk management course with the metrics that we've used in compare stock returns course, and also use some knowledge that we've acquired in this compare stock returns course. So I strongly recommend you taking this one first before starting it. Okay, so after taking the course on investment risk management, we'll learn two things. First, we'll learn how to use a trainer ratio to access our investments performance and track how much our investment is earning us more than the risk-free rate, and compare the trainer ratios to each other. Then we'll also look at the value at risk and see how much can our investment fall in the value statistically. So, and here is what we will do by the end of the course. So here we already have values at risk. We are going to analyze the FANG companies, so Facebook, Amazon, Apple, Netflix, and Google. And here we have an S&P 500 to track to benchmark them against the index. And here we have trainer ratio calculated for all of those companies. So what those are, I will talk in a minute, but let's first go to our open a new sheet. So what will you do now is you go to Sheets, full stop Google, full stop com, and then you log into your Google account. So this is incognito mode. You can safely do so, as I did. And then you open a new spreadsheet, and you create a new spreadsheet, and you should open a file in your desktop. It's called investment risk management. Okay, so let's just do a quick look here. So we have Facebook, Amazon, Apple, Netflix, Google, and S&P 500. This all already have the returns, daily returns calculated for you, because we've already covered how to calculate the daily returns in our previous course, compare stock returns with Google Sheets, and I don't think we should go back to that and spend another 10 minutes on explaining that. So this is how our data looks like, and we'll be working with this data and input everything here. So now let's talk a little bit about risk. So as you already know from the compare stock returns with Google Sheets course, risk can take various forms. One of the forms that we've already seen and compare stock returns course is the risk as the volatility of returns. So if the returns of one stock are very volatile, then that means that this investment is more risky because you cannot know when the stock goes up and when it goes down and how much it goes up and down. And that is measured by a Sharpe ratio. So the reward to this risk. And then we've also looked at Sortino ratio. And we know that Sortino ratio, for it, the risk is basically our downside returns. So not any volatility, but only the returns that are on the downside. And now we will be dealing with the trainer ratio, which is a little bit trickier. So the trainer ratio, it is also a reward to return metric, a risk to return metric, or a reward to risk. But unlike Sharpe ratio, it does not use a standard deviation, so it does not use volatility. Instead, it looks at the covariance of our stock and the index that it corresponds to. So it basically it compares our stock with the returns of the index and looks at the risk from the comparative perspective. Is it more riskier than the index? How much is it riskier? And that's basically what it does. And then we will also look at another side of risk. We have a value at risk. So what it will do is that we'll look at statistics. We'll dive a little bit in classical statistics, and we will see how much can we lose at maximum given a 95% certainty and given 99% certainty. Why exactly these numbers? We will talk a little bit later in the task corresponding to the value at risk. So this is now all for the introduction. And in the next task, we're going to calculate the monthly returns and the standard deviation. So stay with me, and this will be a very exciting project. See you in the next task.